Inside the MBA, your bi-weekly window into what's happening at the MBA.
Welcome to MBA Now. I'm Rob Van Raphorst. MBA recently updated its forecast for the coming years, and with me to talk about it is our chief economist, Mike Fratantoni. Mike, thanks for being here.
Thanks, Rob.
Mike, why don't you first tell us what you immediately forecast in terms of the market switching more to origination based?
Yeah, so we estimate that in 2016 full year, we're going to do 1.9 trillion in volume for the full year. We think that'll drop to about 1.6 trillion next year, but always two components of that. We do expect a further increase in purchase origination volume. We think they'll be up about 11% next year. First year, we're going to be over $1 trillion since 2007. We think we'll be at 1.1 trillion just in purchase volume alone next year. On the other side, do expect refi volume is going to fall off about 40%. So in terms of total origination volume, a drop of about 14% from 16 to 17.
So what impact do you think, or what effect do you think the Federal Reserve will have with interest rates?
So we're looking for the Fed to make another hike here in December. So if you'll recall, in December of 15, they made their first rate increase since the crisis. So we expect 25 basis points increase in December and probably 3 hikes through the course of 2017. They're on their way to probably getting the Fed funds target up to about 3%, but we are years away from getting there. So slow and steady increases in terms of short-term rates.
One of the bigger stories in 2016 was the Brexit vote. I know we talked about it a lot of times in terms of our research. What effect does this international sort of decision of that nature have on the markets?
Yeah, so talked about what the Fed's likely to do, but it really is longer-term rates that are more important for mortgage markets. And we've seen mortgage markets retesting record lows this year. As you said, we had the Brexit vote in June. We also had an issue around the Chinese currency in the first quarter of this year. Anytime there's real disruption in financial markets worldwide, investors tend to flee to safety. They go park their money in treasury assets. That brings treasury yields down, that brings mortgage yields down as well. So bad news abroad tends to be beneficial for those looking to refinance. And there is a lot of things to worry about internationally. So we expect that longer term rates are just not going to rise that quickly given this continuing threat of these global disturbances.
Now, I know it's hard to forecast too far out, but what are your thoughts on 2018 and beyond?
Yeah, so we're forecasting a roughly 10% increase in purchase volume in each of those successive years, 18 and 19. We expect that by the end of 17, refi activity will be at a floor of about 400 billion per year. So don't expect refi to drop that much further. So all in, small increases as we go into those out years of our forecast.
Okay, that's great. We're going to leave it there. Thanks so much for coming by and explaining a little bit of thought that goes into updating our forecast.
Thanks a lot, Rob.
Be sure to follow us on Twitter at MBA Mortgage, or check out Mortgage Bankers Association on Facebook and Instagram.
This is Mortgage News Network.